Exactly. Okay, let's move on to Lululemon, a company that had. I don't think the quarter was necessarily terrible, but I think the outlook. But Aaron has looked at it, and he's going to let you know was what sunk the shares over the past week.
Yeah, Ryan, you're correct. Actually, the quarter wasn't really that bad. There was some margin pressure. We'll get into that, but really, this comes down to guidance and just general economic uncertainty affecting the company, as well as a slowdown in growth. So everybody knows Lululemon. It's an iconic Vancouver-based company, a major player in the athletic apparel industry globally. It was founded in 1998. Continues to be headquartered in Vancouver. Currently, there are about 770 company operated stores, as well as e-commerce and wholesale channels. So this is a strong brand that has been built up over the decades. And it's been a great performer for investors over time. But how is it doing right now? So just before we get into that, the symbol LULU on the NASDAQ, trading at about $240 today, $32 billion market cap company, and no dividend yield at the moment. So when we look at the financial performance of the company, it has not performed well over the last 6 months or so, or certainly since the start of 2025. I'm down a little bit over the last 12 months, but the stock really got hit after the release of its financial results, the Q1 financial results. So it took a 20% share price hit after those results were released, and the stock has continued to trend down since then. So let's take a look at these financial results and see what the problem is here. Revenue, 2.4 billion in the quarter. That's up 7.1%. We actually saw a little bit of strengthening in the gross margin. Operating margin was about flat. And the operating margin was down 110 basis points, so 18.5% compared to 19.4% margin. That's one of the things that investors were looking at just in terms of trying to figure out where the earnings are heading in the future. And then adjusted EPS 260, up 2.4%, so about flat. Comparable sales overall up 1%. So at face value, these don't look like great results from a growth perspective, but they certainly don't look too bad. When we break the regional performance apart, we can see that in the US, the company's experienced a significant slowdown in growth. So revenue is up 3%. For their Americas operation, rather. Comparable sales, though, were down 2%. Now, the international business continues to be performing well. Revenue is up 19% in the quarter, 20% on constant currency, and then comparable sales up 6%. Now, the big issue that investors were not liking with respect to the quarter was the company's guidance, and that was a decline. So they had in the guidance expected for 2025. So the company had already put out earnings and revenue guidance. They revised that guidance with their Q1 results. Not a lot. The previous was $14.95 to $15.15 per share in EPS. And they just basically took a few cents off of that. I think it's 17 to 37 cents. So not a big drop in guidance at all. They're citing dynamic macroeconomic environment, including the tariff impacts and the US market challenges. The problem is that if it were just this guidance reduction, I don't think that the impact of the stock price would have been so extreme. But what investors are seeing here is a deteriorating situation. And at this point in time, it maybe does not appear to be deteriorating at a very fast pace, but the direction is not what the market wants to see. The market wants more consistent growth. And in the case of Lululemon, this is a company that has historically been able to produce double-digit growth. So really, I think investors are concerned that this is just the beginning, that this is just the first sign of a weakening in the company's position. Even if the company does well and the brand does relatively well, you could still see a decline in sales. So those are the main things, really. There's the margin pressure in the quarter being a concern, the reduction in guidance, and then also the weaker performance in their Americas business, which is of course their core market. Looking at the balance sheet strength is strong. So there's no major debt burden. This is a net cash-rich business. So it's 70 million in net cash. So relative to the market cap, not a lot, but that's a good position to be in, especially when you're in a precarious financial position, or sorry, a precarious macroeconomic situation. To be in a strong financial position uh, essentially you're relative to everybody else. When you have a strong balance sheet, you're just better off, of course. Companies also continuing to produce strong free cash flow, about 1.2 billion over the last years. Over the last year, they are doing share repurchases. They repurchased 1.4 million shares in Q1, and then also store expansion. So 3 stores in Q1, bringing the total to 770. Obviously, that's not moving the needle a lot, but going in the right direction. So there are some good things here when we look at the fundamentals of the business. Now, valuation, where are we sitting at in terms of valuation? Well, the company right now is trading at a price to earnings multiple of roughly 18 times. So if you look at the company's historical multiples, 18 looks like an absolutely fantastic deal. However, when the company was trading at those multiples, it was growing at a far faster rate. And it was also not having to contend with all of these tariff and trade war risks as well as most companies are having to contend with. So looking at the valuation based on the current growth rate, I would say that it's okay value, but it's certainly not something where I'm thinking that it's an incredible value opportunity here, even given the fact that this is a globally diversified business or company and an iconic brand. When we compare the PE, the price to earnings, to the growth rate, at best I could say maybe fairly valued or fully valued, but not particularly undervalued when taking into account everything else. So what is our take overall on the company? Strong brand, moat, premium positioning, still a growing market, solid financial fundamentals, strong cash generation. The issues, though, of course, the tariff headwinds that many companies are facing, but some industries are more exposed than others. I would say retail and apparel would fit into that category. This is creating near-term margin pressure, pricing challenges. Valuation appears reasonable, but not necessarily incredibly cheap. But the risks do remain high because we can continue to see a decline in growth and more challenges. And certainly if this company were to reduce their guidance again when the next quarter came out, which I think is a far higher likelihood than them increasing their guidance, would be for them to reduce it. And if they were to do that, I would expect them to get hit pretty hard again. So even though the numbers look good, this company has been a bit of a value trap. We're not ready to jump into it right now. We're just going to continue to monitor, see how the business goes. If growth continues to be slow or challenged, but we're able to buy this company at a much lower valuation, it's something that we can consider. If we're paying 20 times, we want to see a cleaner outlook in terms of what we can expect from those earnings over time.
Yeah, it's an interesting segment of the market for sure. Retail, fashion can be fickle. And you look at the results of, one of our recommendations in this sector has been Aritzia, Lululemon. We looked at, about 5-6 years ago, we looked at both companies at the same time. We looked at Canada Goose as well. And Aritzia stood out in terms of, the type of company that we wanted to be involved in the near term. And Aritzia is up significantly year to date, and Lululemon's down significantly. And again, if you look back over 5 years, Aritzia has significantly outperformed Lululemon as well. Growth at a reasonable price and more of, it has more of a growth avenue ahead of it right now too, that seems to have a little bit more certainty than Lulu at this point.
And that's really what I would say is what you want to be looking for in a company, because we are seeing tough times for clothing and retail in general. I think the consumer spending was down like 3.9 or 4%. I can't remember the exact figure year over year. So when you are seeing these downturns, that good companies, they can either still continue to grow or just not be hit as hard as the ones that are performing worse. And that's how you get those good, long-standing companies, when they will really withstand these poor macroeconomic conditions. And Lulu just doesn't seem to be doing that at this time.
Yeah. I was trying to pull up a chart here on I think Aritzia is up like 529 or something like that. It's actually showing it wrong to me right now, so I'd like to pull it up. But I think over the past 5 years, Lululemon might actually be down.
Yeah, I think it's down like 20%.
Aritzia is like 300 and something percent gain. Yeah. So both great companies, both great brands, but depends on when you are buying them, what price you're buying them at, and do you see growth over the next 3 to 5 years in the business. We saw more growth potential in Aritzia, far lower price at that point, strong balance sheet, and the company has executed well. And again, you got two now well-known brands in the Canadian market, now obviously global in terms of Lululemon, into the U.S. In terms of Aritzia, and just really apples to oranges performance. One has done tremendously well this year over the past 5 years, and one of them has struggled in terms of its share price over that period.